There's a lot of talk right now about non-prime mortgages taking up the brunt of the mortgage market. But what are non-prime mortgages? And what is their impact on the housing market? A lot of people are skeptical and think that the next housing crisis will be caused by these programs. But what they don't know are the details involved with getting qualified for these loans. Unlike the programs from years ago that led to the Great Recession, these programs actually require you to qualify. Back then, qualification required a stethoscope and a mirror. Is this person breathing? Guess they're qualified. But how do they know that individual is capable of making the mortgage payments? Unlike those programs, these non-traditional or non-qualified mortgage products do require evidence of your ability to qualify to buy a property. So one of these programs deals with using bank statements in lieu of your traditional income documents such as tax returns and pay stubs. The way it works is the individual first has to be self-employed, and they have to own 100% of the business from which they're providing bank statements. They look at the total average deposits over a 24-month period and then subtract the percentage of expenses provided by a CPA from that amount. The end result is the annual income used for qualifying. This is much different than what was used in the past, where that same individual can call up their bank or lender, state what their income is, and get qualified on that alone, with not one single document being provided. So there's a big difference. Next, these programs allow for shorter waiting periods after a housing event, such as a foreclosure, a short sale, a deed in lieu of foreclosure, where your Fannie Mae, Freddie Mac, and government products require specific waiting periods that can range from 3 years to 7 years. These programs allow for periods as short as 1 day out of the foreclosure or deed in lieu and short sale. This is because they know that a lot of these events were caused by a one-off situation, which was the housing crisis in 2008 to 2010. This isn't something that occurs on a regular basis. There were a lot of things that led to it that are most likely not going to happen again in the future. Doesn't mean they can't happen, but they're less likely to happen. And on top of that, it has shorter waiting periods after a bankruptcy discharge, where with your FHA mortgages, you have a specified waiting period, and your conventional mortgage, you have a specified waiting period. With this program, once again, you'd be 1 day out of bankruptcy discharge and still qualify for a mortgage. So these programs are actually great for individuals who meet this criteria but don't necessarily qualify for traditional products. If you're having a difficult time qualifying for a mortgage because of some of the criteria I mentioned previously, then reach out to us today. We're happy to discuss how these programs might help you obtain homeownership in the near future.